Let's go.
Welcome, everyone, to Zephyr's Adjusted for Risk podcast. This is Ryan Nauman. I'm the market strategist here at Zephyr. You know, duration has been a hot topic in recent years, especially during times when interest rates were at historically low levels. Well, interest rate volatility has picked up this year as macro and market uncertainty is heightened. Well, I have on the perfect guest to talk about duration, the fixed income markets, and what it all means for investment portfolios moving forward. But first, this episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. All right, let's get started and bring on the star of the show. I'd like to welcome David Sherman. David is the founder and CIO of CrossingBridge Advisors. David is also an adjunct professor at NYU Stern School of Business. David, thank you so much for coming on the show. It's an honor to have you on. Can you please tell us just a little bit more about yourself and CrossingBridge Advisors?
Sure. I started in the industry as an intern in 85 and 86, working for Drexel Burnham out in LA, and then started my career working for a firm called Leucadia, which is now merged into Jefferies. And my mentor, Joe Steinberg, is the chairman of Jefferies. And in 1996, left Leucadia to start my own firm in primarily credit opportunities. And I've done the, hedge fund business where, it's an excuse to charge egregious fees, but not really anything. And I think our investors were pretty happy with those results. And in 2005, we closed that fund to new investors because there wasn't a lot to do, not because I saw the writing on the wall. And in 2010, we sort of decided to take our skills that we were using and see if we could apply them in the mutual fund industry. And where we're matching people's needs or targets or horizons with a set of investments that provides a lower volatility, reasonable profile. So that's the evolution of CrossingBridge. And today, CrossingBridge is a $4 billion asset management company, primarily with mutual funds and ultra short duration, low duration strategies, as well as some strategic income allocations. We also have a UCITS and ETF.
Fantastic. Thanks for that recap. David, interesting timeline. I like your thoughts on the hedge fund there. That was good. When doing research on CrossingBridge, one thing that came to mind, and whenever I do manager due diligence on a mutual fund or manager, it's always about, I start with the investment strategy or the investment philosophy of the firm or the manager. And is there conviction there? Is it consistency in that style? And one that I came up across when researching CrossingBridge, and one of your fundamental beliefs is return of capital is more important than return on capital. I thought that was interesting. Can you maybe give us a little bit more insight on that approach?
Sure. I don't think we're unique to that value investment statement. I think we can thank a lot of really brilliant people, including Warren Buffett, for the concept. And my mentors at Leucadia very much emphasize that you make your money by protecting capital first and then waiting for the right opportunity, also known as the fat pitch. I think if you're very good at protecting downside, and it's hard because you make mistakes. Everybody makes mistakes. We make plenty of mistakes. But if you focus really, really in a disciplined way, I think then, particularly in fixed income, in credit, you're earning a coupon. So you're going to get a return. Maybe it's a lower return or a higher return than some other opportunities, but you're getting a return. You're being paid to wait. And if you have the right opportunity, eventually, if you get it right, you'll get a total return kicker. And what you really want to avoid is things where the bear market we've had in interest rates that people may have forgotten about, but were just 2 years ago, which were probably the single best signaled bear market in the sense that the Fed told you were they going to raise rates and you just had to believe them. Or things like the invasion of Ukraine, which added a lot of volatility, but also opportunity, as well as the current are we having a trade war or not event. All of those create volatility. So if you can have a portfolio that's mark to market, not permanent impairment, so and you have dry powder, and the ones that are mark to market will earn their way out, and you're protecting capital. In the meantime, those cash flows, those coupons, and not making permanent hits to your portfolio will allow you to take advantage of the market. And if you do that over time, you'll beat an index if it's the appropriate index. I know you're, but you said you think it's really great to protect capital. And I think for your listeners, I think there's something they really should be focusing on if they want to protect their capital, which is I think there is a mismatch between investors' allocation of how they're going to make their investments, whether it's
Mhm.
FANG, bonds, stocks, crypto, whatever it is, and their time horizon, right? I think there's this big thing of, well, you just buy it and set it, except you can't buy and set everything. And that's not human nature, right? So I use this example all the time, Ryan. And you and I think talked about it offline earlier about, somebody's kid's going off to college and they've saved all this money, right? And they're starting in the fall and they're super excited and they've got all this money and 4 years is covered. Well, and they did it by investing a little more aggressively because they were younger, they need to do it,
Mhm.
not like an older person's more income oriented. So let's say they had a very heavily equity type return component. Well, are you going to leave it in there? I mean, you just saved all this money. What happens if '08 comes,
Yeah.
or '02 comes, or '98 comes, or COVID comes? So what they should be thinking about is, well, the check for this year's out the door. I got 3 more payments. Well,
Yeah.
maybe the fourth payment you can consider leaving the way you've invested it, but the next two, you need a peak to trough back to peak kind of horizon, right? So maybe they should take year one and put it in like a 1 year CD or money markets
Yep.
or something, or an ultra short duration, and maybe year two in a low duration, which gives you a little more return, a little more volatility, but it's not so far out. It's more than a year, but less than 3 years. And that last piece, I would probably still do low duration, right? And then they just became a sophomore, and you just keep cutting back and
Yeah.
redeeming the same way and redoing it. So that's how one way of protecting principal that's unrelated to actually the investment you're making.
Yeah, David, that's fantastic. So much to uncover there. One thing I love you said at the beginning of that response is protecting the downside because then it gives you more assets, protect your assets to, appreciate or capture more of the upside. And like you said, at Zephyr, we've done a ton of research on the evolution of risk. Years ago, when I started, David, 20 years ago, it was about standard deviation and volatility. David, give
And
me
those were
all the upside.
portable alpha, baby.
Yeah, exactly. Give me all the upside deviation you want, right? I'll take upside deviation. But as you go on, and you said it, the real risk is, not receiving that capital in return, right? Or losing your money, not whether your volatility over the mean. To me, it's receiving capital, protecting that downside. So you said it perfectly there. Um, Thank you. And then the other one, yeah, is, just focusing on a basic approach and focus on goals, right? And not so much short-term aspirations. I did um, a piece real quickly on how if you just exactly what you said, if you created a portfolio, diversified portfolio 10 years ago and did not touch it, what that diversified portfolio looks like today, and it would be, double in large cap growth, right? And is that really what you want, that exposure to large cap growth? Probably not.
Look, I think you can have a portfolio where it's like a puzzle. Little pieces make up the whole picture, and you figure out how to put it together. And, there are parts of your portfolio that can take risk, but even it depends on how you define risk.
Mm.
So, like let's take something like crypto, which is foreign to both you and I think.
Yeah. Yes.
Look, it's an asset class now, and it's a store value asset class. I don't own any crypto. I'm not advocating crypto, but I understand what it is, right? So, I was on a hike with a young lady who bought crypto, she says, in the $100. Good for her. She's held on to it. Talk about long-term investment. She's held on
Yeah.
to it. And, she said, what do you think? And I said, look, I think it's made the transition to be a permanent asset class. I
Hmm.
said, it wasn't for me. I understand what it is. I believe in blockchain technology. I don't buy gold either, by the way. So to me, it's similar to gold, right? It's
Yeah.
that I want a reserve currency. I want a devaluation of dollar, the end of money. And if you read the Hyman Republic when they had the end of money, what worked actually was apartments that didn't have debt where you could barter to make to capture. I said, I believe in hard assets. It's just not for me. I said, but I understood what it is. And I think one of the things that gets people in trouble is they don't understand what they're doing. They just get FOMO, fear of missing out, and they don't remain disciplined. And she said, well, what do you think of crypto now? I said, and I said, look, and she was telling me why it wasn't gold and all. I said, look, I think the big risk to crypto and really Bitcoin, because the rest of crypto is a
Yeah.
completely different thing. I said, the big risk to Bitcoin, which is what she bought, I said, is if it's a devaluation of currency and it's denominated in dollars, that works if the dollar devalues. And it may or may not work if the dollar loses its reserve currency and how that whole evolution comes. I
Yeah.
haven't thought that through, but there's an issue. I said, but what happens if the dollar becomes Zaire and it becomes so devalued? Well, Bitcoin's quoted and priced in dollars.
Yeah.
So she goes, oh, well, it holds its value. I said, well, if something, it's like, what's the limit theory of, certain things? It's infinity. That's not actually the case. In this case, the limit theory of infinity is usually zero. It goes to zero because they don't want your dollars. So I think I'm not suggesting for anybody who's on any of your listeners that are holding Bitcoin, that's a case or that's it. But I'm saying the point is I've actually thought through what the risks are. And I think if you can really think through and say, I'm comfortable with that outcome, then you really understand what you have. And that's a big part of protecting your principal and
Yep.
protecting your downside.
You're exactly
Little
correct.
off track, but it was a good example on the extreme.
Yeah, and on the knowing your risk, we talk a lot about what are the risks today. There's geopolitical risks. You can talk about a monetary misstep, but at the end of the day, it's a long-term risk. And you said it exactly. Understand what your risk is to achieving your long-term goals, whether that's 10 years down the road, 15, 20. Think long term. Yes, today we've got a lot of risk and it's can be hard to sleep at night, but you got to think long term and really understand those risks.
And
Uh,
Ryan, don't you often talk about high dividend paying stocks?
yeah, we do talk quite a bit. Yeah, and it's interesting you brought that up, David, because a lot of times it gets lost in the shuffle over the past 2 years, 3 years we've been doing this because growth stocks, everyone wants to talk about growth stocks and technology and AI, but you're exactly correct.
What I think is great about that strategy, right, is it sort of is a hybrid to fixed income, right? You get to the extent a company's earnings grow either through inflation or organically or inorganically, and they have a fundamentally great business, right? And those dividends will then grow as well as the underlying value of the company. And if interest rates go down, right, the PE multiple or the cap rate adjusts favorably to them. If
Hmm.
interest rates go up, you get that negative adjustment because it's a long duration asset.
Yeah.
So one of the things I like in today's current environment with all the uncertainty between where is employment, where are trade wars, where is America First policy, where is onshoring, where is uh, all these factors involving interest rates, you know, who knows? Like, I don't know if we're going to a recession, a boom, a stagflation. But what I love about that strategy they're doing that really is perfect for low duration today is the difference is in fixed income low duration, meaning things that have a short maturity. And when we say low duration, it's really a measurement. Well, if interest rates go up, you lose less. If interest rates go down, you make less,
Yeah.
right? As opposed to your dividend paying stock where because the sensitivity to interest rates, right? So what I like is if you have a portfolio of 3-year bonds or 4-year bonds, there's a day of reckoning. They're either paying you off or they're not. And you can then figure out your reinvestment. Whereas a dividend stock, you have to depend on the mark to market on the daily what it gives you. But they're very similar in a broader respect. So, and there's a lot of great dividend paying stocks that are better substitutes, but you have a long duration, meaning they have more yield. One of my favorite dividend paying stocks again, not about low duration high yield, right now is something called FLNG, and it's an
Okay.
LNG guy. And why do I like it? We may be wrong, but it has a very high dividend yield, like north of 11%, north of 12%. And John Frederickson's a well-known shipping guy who's a value successful investor who's behind it. But when you see dividend stocks up at 10, 11, 12,
Yeah.
13% in this environment, it's telling you one of two things. I tell my students in NYU all this time. Either the dividend's getting cut or the price is going up, but it's not sustainable to stay at that level, right? And the job of a good analyst is to figure out, is the dividend getting cut?
Or
Not. And if it's getting cut, is it priced in? And in our case, even the dividend will get cut, we think it's priced in, and we're not convinced the dividend is necessarily getting cut. But you know, what I love it, so that's a dividend paying thing. And what I like is the dividend's so high, it's creating a catalyst down the road. Well, what I like transferring that to low duration is if I can pick up a bond, you know, uh, that's super senior, money good, yielding, and we have them, 8%, uh, 8.5%. And in today's market, that's pretty good because a lot of the stuff trades at 5.5%. And we think it's definitely coming out. It might come out earlier in the maturity's money good. That's rock solid. And I'm just tying up my
yeah.
horizon for 3 years.
Yeah. Fantastic. You briefly covered, what is duration, right? Interest rate sensitivity when you're getting paid back your money. What makes up duration though? I think what is duration, most people understand, but kind of what makes it up? What makes up duration?
Actually, I'm not even sure people really understand duration. Everybody assumes duration is like a period of time length, months,
Okay.
years, etc.
Do you
And
think
that's
they get maturity and duration confused a
Yeah.
little
In
bit?
fact, I think people just use duration maturity inter inter
Mhm.
symbiotically and not realize there's actually a significant difference, right? Maturity is when your money is due, right? Period. I borrowed money from the bank. It's due in 5 years. That's my maturity. I have to pay it off in 5 years. But a 5 year loan from the bank isn't necessarily a duration of five.
Yeah.
If you don't make any interest payments, you have a zero coupon, your duration always matches your maturity. So in that case, they're the same. But if you pay a coupon, you're getting cash flow, you're paying cash flow, or the other side's receiving cash flow, which is reducing their cost of their original outlay of capital, right? So it's a present value concept, right? So as the bigger the coupon, the shorter the duration, the lower the coupon, the longer duration relative to its maturity. So if you have a 5 year maturity, zero coupon duration of 5 year maturity with a high coupon, I don't know, 10, 14%, and sinking funds where they pay it down every year equally, that's going to be a duration of like two,
Hmm.
right? And what does that mean? Well, how can you have a 5 year maturity that pays out with an average life of 2.5 years, right? Because you're paying out every year, and a big coupon. How can that be even lower than the average life? And the reason is because of present value. Because what it's saying is, if interest rates go up 100 basis points, what should the price adjustment approximately be on this security? So if interest rates go up 100 basis points and your duration is 2.5, the price should drop instantaneously about 2.5 points or 2.5%. And the opposite, if interest rates go down, you should go up 2.5%.
Yeah.
Now, that's so obviously if you have an equity, it has a huge long duration. If you have a 30-year bond, it has a huge duration. So it's meant to sort of give you an idea of how much opportunity cost you're giving up by price adjustment or opportunity gain you're getting by price adjustment is really a measurement of duration. And I probably confuse people even more now, but that wasn't the intent.
No, that was fantastic. I love the example, and I don't think people when and now analyzing fixed income, there's so much more to it than just equities. Equities, yes, there's still duration, like you said, especially in those dividend paying stocks. But we got credit risk, like I said, duration risk, a lot of other different types of risks that you have to think about. So duration is very important. But we talked about low duration. And during market volatility, if interest rates were to happen to go up, low duration might be a good play. but there might be risks to low duration. Are there risks out there?
Sure. Um, so if someone's incorporating a low duration strategy, right, either because their horizon is short or because they want to be more conservative because they're concerned that interest rates may go up or that the spread you need to get paid to take risk, whether it's premium risk or anything, is going to widen. We call it credit spread, but it could be anything. Or they just want to, instead of putting it in money markets and batten down the hatches, they want to get a little more return to batten down the hatches, right? That has risk. So one of the things is if you're wrong, rates go down a lot or credit spreads tighten, right? You're reinvesting lower, right? And reinvestment lower really can hurt you in the long time, right? Because you could fall behind, let's say, cost of living adjustments or inflation. The other thing is you could just make a mistake, right? One of the concerns a lot of people have is, well, why do I want to buy a bond at a high price, right? Or even par, or even a premium to par when it's due in 15 months? Because what happens if they don't pay, right? So, we see situations where somebody will say, my bonds are due in 2000, today's July of 25, right? Just to give a text. So my bonds are due in 2 years in July of 27, and they're trading at a 9% yield to maturity. And, you know, all the bonds that are equal with it, meaning if the company went bankrupt and you did a waterfall, like these people get paid first, these
Hmm.
are all equal. The other bonds that are just equal, same place, but they're due in 6 years. They're trading at 15% yield to maturity, a lot more, and a lower dollar price. Well, what is that telling you if they're equal? It's telling you you're getting an above market return. Remember, the market's 5.5, 6%. You're getting
Yep.
10 because people view it as it has real risk to it about repaying you at principal. But you're betting you're going to get paid off, and it's the guys that are equal with you that may have a problem down the road. So you're quote structurally ahead of them. I know this is a little complicated, but it's actually an interesting
No,
fact.
this is perfect.
Well, what happens if they don't make the maturity? Well, the bonds that are trading down at the 80s, guess where your paper's going? It's equal. It's going back down because they missed the payment. I don't like those investments, and I think it's a really good test for your clients and your listenership, excuse me. They can look at, ABC bonds in 27 trade here. Where do the ABC bonds trade in 30? That's 5 years.
Hmm.
And if the spreads are about the same, that's meaning the difference between a 5-year treasury and the 5-year bond or a 2-year treasury and 2-year bond. Then that tells you people sort of view the credit risk equally. But if they say, oh, I'm getting paid a lot more or they're much lower dollar price down below, that might imply a potential risk down the road, tail risk, right? And people are like, yeah, but these are coming out before everybody else.
Yeah.
Well, they are until they're not. So it's a little bit, I call it merry-go-round investing. You're getting on the merry-go-round betting you're getting off before everybody else. But if you don't, you all spin and spin and spin, and then you get sick. So we like to avoid those. So that's a risk with low duration. But the opposite end, and then I'll finish, there's a positive to that. Most companies don't want to have a bond that's due in 1 year on their balance sheet because it goes from
Mhm.
long-term debt to current liability. And auditors don't like a lot of current liability. So they
Yep.
want you to show you clean. So the more speculative you get, meaning junk bonds, high yield bonds, often you'll see those bonds come out before their maturity, usually way more than a year before maturity, because the CFO doesn't like uncertainty. So he doesn't want to hope the market's cheaper a year from now. And the auditors don't like it. So that, depending on what you pay for the bond, that can work to your advantage because you can actually have this de facto shorter maturity.
Yeah. Fantastic. Fantastic. I love the in-depth on the fixed income side. It's great. You mentioned high yield bonds. Perfect segue here. Surprisingly, or maybe surprising to some, but high yield bonds tend to exhibit lower duration than investment grade bonds because they have a higher payout, like you were talking about earlier, uh, a higher interest rates, higher
Well, their
yields.
their maturity as an industry is dramatically shorter than investment
Mm.
grade.
And so they can be attractive during times of interest rate volatility. But what are your thoughts on high yield bonds? And do you think, can you provide some tips to financial advisors when maybe they're looking to add high yield bonds to shorten their overall duration?
So it's a great question. Generally, high yield bonds have always had a shorter maturity than potentially investment grade bonds because they're more speculative in nature. And therefore, the buyer is concerned about looking out into the future about getting repaid. But if you're the issuer, you're the company that they don't want to buy at high rates if they think they're improving, because if their company improves, why pay this rate for
Yeah.
so long? The example I give people is, why do you want to take a 30-year mortgage if you think you're moving in 12 years? Right? You're paying a higher rate for that extra security that you're locking in, right?
Yeah.
But you're moving probably in 7 to 12 years, you've mismatched. So it's the same kind of issue. As you'll find in cycles where people are concerned about credit, the maturity shorten and shorten and shorten, so the index gets shorter. The opposite is starting to happen now. Two reasons. One, people have been thinking, well, if rates go lower, I want to have a longer exposure. But two, people feel more certain. But three, they're just extending. So it does shorten, extend, shorten, but aggregately, so does investment grade, it changes. You have to be careful. Leverage loans, they're floating rates, so people don't think
Yeah.
there's a lot of risk. Except if you have a 7-year, they're issuing 7-year high yield leverage loans at a spread of, let's say, 350, that's now down to 300 because they keep recutting the rate. That means you're stuck at 300 basis, 3% more than Fed funds, let's say, or SOFR, right? But for 7 years, you've got a
Hmm.
7-year. So there's a mismatch. So I would say leverage loans right now is an area where people should be concerned. But from an advisor or individual standpoint, look, I think I've never been a proponent of long duration assets unless you're getting equity type returns.
Okay.
Because why, or you're getting a hybrid of equity type returns, because why take interest rate and volatility and future risk, right?
Hmm.
Like, look what AI is starting to do. Look what the internet did, right? So I'd rather say, if I'm being paid, it's one thing, but if I'm not really being paid and my upside's capitated or restricted because I have a
Yeah.
coupon, I'm not a big fan of that unless I want to bet that rates are going down. Well, I can go buy a treasury to go do that. How much incremental return do I need? So I sort of like short duration. Then I'm just going to get on my gerbil wheel and run really hard and figure out where I'm going to make my next money. And as a value investor, I'm opportunistic. Um, so high yields shorter because that's what the buyers will bear. Um, I don't think this is a conversation. Should you buy short duration, short high yield because they're shorter in duration, or investment grade because they tend to be longer? Again, I think it depends on what it is. Like, take the ag. The ag doesn't have much corporate exposure,
Yeah.
right? So maybe you don't have enough corporate exposure and you have too much MBS, mortgage-backed security, and treasury exposure. So I really think you have to look at the underlying components.
Yeah. I'm glad you brought up the egg. We often talk about concentration and equity indexes. I tell you what, the egg has arguably higher concentration in treasuries, MBS, and a lot of people who buy egg, they may not know that, right? The egg index or the ETFs that follow it, and there's some risks there to just being overly, concentration in the treasuries.
Yeah,
So,
look, I think passive investment is an excellent strategy. I think active investment is an excellent strategy. I think using an advisor is an excellent strategy. I think doing it yourself is an excellent strategy. I think your point is the same that I've been trying to say, which is understand what you're investing in. Or if you're giving someone else that decision, understand, which is what you started off at the very beginning of this conversation, that they know what they're doing and that you feel comfortable with what they're doing.
mhm.
Um, uh, and in our case, uh, a really bright man once said to me, I went to go market to him, and he said, "Well, let's use low duration high yield because we're in that topic today. Well, in this low duration high yield product that you have, what's it yielding?" He said, "I don't know. It's yielding, let's use today's rates. It's yielding in a high yield low duration strategy today, net of fees, 6, maybe 7%." Okay. Goes, and what's sort of a low duration high yield index? And in our case, it's not quite comparable because we tell them, we own a lot of investment grade, et
Yeah.
cetera. And we say, like 5.5%. He goes, oh, so you're getting me net of fees on a run rate basis, 100 plus basis points or 1% more or 20% more return. Like, yeah. Because, well, that's pretty good. what risk is the index taking? He didn't ask what risk I was taking. He asked what the index was taking. So I went through all that. He goes, well, how is your risk different? And then he said, and then what additional risk am I taking to take the 100 basis points? And then he said, and how would you compare that to this thing over here where I can earn more return and the risk there versus here? So it was really, really six simple questions
Yeah.
for him to discern. And it got right to where you are. Like, what's the most important thing? So when people say to me, what's the most important thing in high yield investing? And I say the most important thing is to think like a value investor, which is why I don't like the indices unless it's
Yeah.
like I'm just because each one's a story. And the next important thing as a value investor, I think people don't really focus on capital structure and working capital to the degree that they should. Um, and they also don't focus enough on the business model. And I really want to bring one point home, which you didn't ask, which is we don't generally invest in financial companies
Okay.
as a lender, as an equity holder or dividend payer.
Y-
But let's take a bank. I'm lending money to a bank. Well, either they're going to pay me off or it's a problem. And if it's a problem, I'm not getting a partial recovery,
Yeah.
right? You invested in bonds in First Republic that didn't work out so well. And you don't really know what they own, right? They're managing this book of
Yeah.
investments, no different than I am as an asset manager, but they have counterparty risk. I also have counterparty risk. They have spread risk. We have spread risk. They have underwriting risk. We have underwriting risk. They want the capital markets to be alive and well. We want the capital markets to be alive and well. The only big difference is they leverage six,
Yeah.
7, 8, 9, 10 to 1, and we don't. So as a lender, why would I want to do that? But as an equity holder, it's more interesting. So I think understanding just sort of basics of, anyone can do. Anyone can do this. Like, what does a bank do? Is this a risk I'm comfortable with?
Yeah. David, fantastic. Real quickly, couple minutes left, and this could be a whole conversation on itself, but I just want to get your view on, the dollar softened recently, a lot of talk about international foreign stocks and equities and opportunities there. Is there, in the fixed income side, do you believe there's any areas or regions outside the US that are attractive that may not be getting enough attention?
I do actually. You know, we've been an investor, and people are going to think I'm crazy, but we've been an investor in the Nordic markets. This is Scandinavia, Norway, sorry, Sweden, Norway, Finland, and Denmark. Those are what I describe as the Nordic markets. And we've been an investor there because I was really interested in fish farming because I came from an agricultural background.
Okay.
And that was back in 2004. So I've been there quite a while. But they had a very small sort of fixed income market and really small high yield market. But, the nice thing about the Nordic guys is they get it right.
Okay.
And what I really love about their market is one, it's not just Nordic companies. US companies are issuing out of there.
Yeah.
European companies are issuing out of there. If you go to Germany, there's $24 billion of mutual fund type product invested dedicated to that market. And what I love about it is it's floating rate with short maturities. Typical maturities 3 to 5 years. It's typically floating rate. Oh, they're typically secured. Oh, they've got what they call covenants, contractual property. The company can only issue so much debt
Yeah.
and they have to be in compliance. They have maintenance. They have real teeth to rights for lenders, which you don't have here. Here in the United States, things are covenant like. So what I love about that business is it's becoming an international platform for lending to compete against direct lending. And the spreads there are, you know, 50 to 100% more than what you can get in the United States. So here you can either hedge back into dollars or you can get a portfolio of krone, Norwegian krone, Swedish currency, the Denmark's and the euro, but you can get a diverse currency. We hedge back into dollars, but you can keep it if you want to get them out of dollars. You're getting much more return, much better covenants, and really high quality companies. They tend to be smaller. Anyway, there's
David.
only one Nordic bond fund in the country. I want to be careful from a regulatory standpoint, but CrossingBridge Advisors really likes that space.
Awesome. David, such an awesome conversation. I knew it when we had our prep call. This was going to be a fun one. I love getting in depth about duration and fixed income. It was such an honor to have you on. Thank you. Where can our audience get more information about Crossing Bridge Advisors?
Oh, this is a marketing pitch. Okay. So, first of all, you can certainly email me at dsherman, Sherman, like Bobby Sherman, who just died, dsherman at crossingbridge.com, CrossingBridge.com. You can go to our website, crossingbridgeadvisors.com. You can also email John Connor, J. Connor, at crossingbridge.com.
Fantastic. David, thank you so much. It was really a pleasure. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and on Spotify. Please remember to like and subscribe to those channels and give us a follow on LinkedIn. Thank you very much and have a great rest of your week.